So the fund has a very simple philosophy to own quality growth businesses which are trading below their intrinsic value. And as far as possible, we look for companies that are completely unrelated to the macro environment. So for that reason, we find that the portfolio is usually very underweight sectors like financials, materials, and energy stocks that are completely dependent on factors like interest rates or commodity prices or the oil price. The sectors where we're overweight at the moment, it's IT, industrials and healthcare, so very bottom-up stock-picking sectors where the stocks tend to be very uncorrelated with each other. So if you look on a domicile basis purely, then our exposure is around 30% to the UK. But the UK market is home to very international companies that just happen to have their listing in London. So companies like Experian, which is a top holding in the fund, Prudential and Shire Pharmaceuticals, for example, are very international in their revenue basis. And if we look just at revenues, then actually exposure to the UK is closer to 12% versus the index of 10%, so a much smaller overweight position. So for that reason, we think that the fund will not be impacted too strongly by Brexit, particularly as we're looking for companies that will grow regardless of the political backdrop or the macro backdrop. So a sector that we've been finding some very good opportunities at the moment is actually the tobacco sector. It's a sector that has been hit on a number of concerns. So things like the fact that traditional tobacco products are declining in volumes. The FDA in the US has been talking about banning menthol products, for example, and increasing regulation. Also, there's the threat of new product introductions in next generation products like heat-not-burn technology and e-cigarettes. And all of that means that the valuations on the traditional tobacco stocks have come down from around 16, 17 times price earnings multiple down to 8 or 9 times with very high dividend yields. So the valuation now is looking very compelling, and these stocks are very cash generative. They have had no downgrades in their earnings and are still very stable companies. We think that the traditional stocks will be very good contenders in the next generation products. They're developing their own. And also the fears on the US regulation. The US is not the whole of their business, and if, for example, menthol products were banned, then we would expect that demand to be taken up in some of the other tobacco products rather than disappearing completely. So as we come to the end of quantitative easing and normalisation of interest rates, that's one area that might introduce some more instability for investors, especially when that's coupled with cyclical macro worries, potential slowdown in the global economy, plus political factors on top of that. So that market volatility could be expected to persist into the coming months. That said, European equity markets at the moment look quite attractively valued versus their long-term average, and especially versus the US market, for example. So for patient, long-term growth investors, that there might be some opportunities to find really good quality companies at attractive valuations during this period of volatility.